Hello everyone, and welcome back to this BKR webinar on commercial and tax considerations of buying a business. So greetings from BKR Towers here in North London. I'm Anthony Newgrosh, and today I'm delighted to be joined by Daniel Shear, our corporate finance partner and supporter of the greatest football team to come from Stretford. Hi Dan.
Good afternoon.
And also the winner of Taxation's Rising Star, don't be shy Sam, 2022, our very own Sam Inkersol. Hi Sam.
Hi there.
Okay, so thank you very much for joining us, everyone. Could you try again? Delighted you could join us. Just a bit of housekeeping before we start. We will circulate a copy of these slides afterwards and a copy of the presentation should you like it so much you want to listen to it twice. But if you do have any questions as we're going along, feel free to type in the chat box. We'll endeavour to answer what we can as we go along. If not, we will try and pick up questions afterwards. And we do very much welcome your input and thoughts, so feel free to type away. So that's enough by way of background. Let's start just by sort of setting the scene. Well, who we are, I think we've covered that. What will we be covering today? Well, Dan's going to look at everything from a corporate finance perspective, why and what we should acquire, valuation issues, how we structure the deals and the process generally. Sam and I will look at the sort of mirror of that from a tax perspective, the tax considerations, so the sort of issues that come up, due diligence issues, the tax warranties, indemnities, different tax implications depending on how we structure the deal. We'll look at that, but we're going to focus very much from a buyer perspective today. We might, if you're all very lucky, do a follow-up from the seller's perspective. Now, the two obviously do overlap, but we will be focusing from a very much a buyer perspective. So that's what we're going to do. And to start with, let's just think about, Dan, the current landscape at the moment for these sort of deals.
Yeah, it's a bit of a funny time at the moment, Anthony, because obviously we came back off the end of lockdown and we're heading to, well, whether we're going to go into a recession or not is actually a moot point. I mean, technically we're not in a recession. We avoided it with 0% GDP in the last quarter, but there's a lot of uncertainty in the marketplace, which often spooks people away from deals. On the other hand, there's a lot of what's called dry powder out there. A lot of funds in particular, and a lot of trading companies that are acquisitive, have not been able to deploy the money that they would have otherwise wanted to spend in the last few years, and they're desperate to do deals. So we'll talk about valuation in a minute. There is a downward pressure on valuations, but it's certainly, although it's maybe quieter than more buoyant times, there is still a lot of activity out there, and there's certainly a lot of buyers out there competing for the sexier assets.
Okay, so that's sort of with our corporate finance hat on. Sam, what are sort of the key drivers and points on the horizon from a tax perspective?
I think we're all very aware that we are in the UK in a rising tax landscape. We can see corporation tax rates going up to 25% from 1st of April. But there's also, and there has been rumours of raises in capital gains tax rates. Whether the Conservative government will bring those in, we don't know. We know they've dropped the annual exemption on capital gains for individuals from 12,300 to 6,000 for the next tax year, and that's still dropping further going forwards. But whether capital gains tax rates do go up for individuals is possibly still on the cards, especially with the change in government, given we've got an election in 2025.
Yeah, it's very difficult to speculate, isn't it? We've been hearing for the past 3-4 years that CGT rates may go up. We have had restrictions on the limit, the lifetime limit for entrepreneurs, relief purposes, and that's now down to £1 million. But yeah, we'll have to wait and see, I suppose, on that. But I think you're right, Sam. CGT rates are certainly not going to come down any further, and the concern is watch this space for the budget coming next month. They could go up, but we know no more than anyone else. We'd hasten to add on that point. So that's sort of the current climate at the moment. Dan, let's sort of start from first principles. Why would you buy a business?
So, I mean, I've listed some of the main reasons up on the slides. I don't necessarily need to go through them all, but obviously, you know, growth is the prime driver of any acquisition. It could be to diversify away from the core business, but often it's to acquire a strategic customer, to grow your market share. It could be to acquire some specific members of staff. It could even be to acquire a specific supplier, if there's a key supplier that you're sort of blocked from using or something. So there are lots of different reasons to acquire business. I think the key point is to really think about why you want to make an acquisition before you do it. There are lots of statistics out there which suggest that most acquisitions, and you can see various different percentages, but the most often quoted one is around the 72% mark. Most acquisitions fail to increase shareholder value. Now, obviously, if you're looking to acquire a customer or acquire talent, you're probably less worried about shareholder value in the short term, but it is something to be aware of. So I think before anyone goes in the acquisition trail, they do need to think why they want to do it and have the right reasons lined up.
Yeah, fair enough. And maybe we'll come back to that right at the end. So how do you find a business, Dan?
Well, really, you use someone like myself. A little plug there. We interact with lots of other corporate financiers, and we share opportunities and needs and databases with each other. So we've got access to a lot of businesses that are for sale that other people wouldn't necessarily be able to come across directly. It's always worth looking overseas at the moment. For SME type deals up to about 10-15 years ago, you wouldn't really do many SME deals with an overseas company, but we're finding that it's the world's becoming a global village now, and we're finding that nearly half of our deals now have an overseas element to them. So it's always worth looking overseas because there could be something very strategic there. There's obviously a big difference between looking for companies that are ready for sales, so you've got a willing seller there, versus making an unsolicited approach to a company which isn't for sale. Obviously, they might rebuff your approaches, but if you make unsolicited approaches, you've obviously got a much bigger target of potential companies to acquire than if you're just looking at those that are ready for sale. And those that are for sale, you've got to sort of ask yourself, why are they for sale? It could be a genuine retirement sale or diversification, but it could be that there is some concern that the vendors know about that we don't know about. So it's always worth having that strategy lined up in advance as well. As this is an acquisition discussion, not a disposal discussion, it is worth pointing out that sellers obviously prefer cash-rich buyers. So if a deal is going to be delayed because the buyer then needs to go and raise finance, and we'll talk about that a bit later, then obviously it can delay the process a lot these days. I mean, in particular, at the moment, financing is taking a lot longer than it ever used to do, and that could be a concern to sellers. So cash-rich buyers often win.
Okay, now one of the key issues is going to be to agree a price, and valuation is very much an art rather than a science, Dan. But give us a steer here.
Absolutely, I've put down on this slide various indices which are published. PCPI is the private company price index, which is published by BDO every quarter. One of the problems, I'm not sort of knocking BDO or anything like that, but one of the problems with PCPI is it's using publicly available information, and therefore the reported information won't necessarily be adjusted to the underlying earning figures, or if the consideration includes a property, for example, they might not necessarily know about that. So sometimes the figures that PCPI is suggesting can be skewed. It's still a very useful index, but it should be, the actual quantum of the figures should be treated, with that in mind. Mark to Market is another index put out by Mark to Market, a data provider, and there they actually get people like corporate financiers such as myself to actually provide data to them, and the data that's provided by the corporate financiers is adjusted, so they like to think that their index is going to be a truer reflection than, say, the PCPI. UK 200 Group has an annual index that's much more focused at SMEs. They feed their data into Mark to Markets as well. There are other indices out there, but these are the three that we often refer to. And the point of this slide isn't really to say, oh, you should be paying X times EBITDA of X being 5.4, 9.6 or whatever. It's really to show the trend and that in particular there is a downward pressure in late 22 and even early 23. You can see that the 22 figures are all below the 2021 figures. Obviously, things were down in sort of 20 anyway because of the lockdown. They picked up again in 21, but there is downward pressure because of the economic uncertainty and the mess that was created in the Truss government and everything else. But it gives you an idea of valuations. It's worth pointing out very quickly that these figures are what we call enterprise value over EBITDA. So it's effectively the value of the trade divided by the EBITDA.
Okay, but this is very much just a starting point, isn't it? And ultimately, it's whatever anyone is prepared to pay for your business. So
exactly. I mean, we do in BK Corp Finance, we do a lot of business valuations anyway, standalone valuations. But whenever anyone's saying, I want to buy something, can you value it? We say, well, there's no point, because it's only going to be what you're prepared to offer and what the vendor is prepared to accept. And anything we put on a bit of paper is irrelevant. So it's really down to negotiation.
Yeah, good old fashioned haggling. Okay, thanks for that. Now, there's two sort of very fundamentally different ways of structuring a transaction. Well, this is what we're going to focus on for the meat of this session, I think. But Dan, do you want to just give us, a quick overview of the alternatives here?
Yeah, so you can either buy, we're talking about companies here specifically, so you can either buy the company, buy the shares in the company, or you can open the company up and cherry pick whichever assets and liabilities that you want to acquire from the company. So you leave the company behind, and typically a newco will just acquire the assets, whatever liabilities they're prepared to take on, and the trade, the business, the know-how. One thing to think about in particular is on property transactions. We've been involved in a large number of property acquisitions where the property for sale, typically a commercial property, is wrapped up in a company. The estate agents who've been instructed to sell the property will agree a price, let's for the sake of argument say £20 million, and they'll typically prepare some kind of head saying £20 million for the shares in the property company. Well, of course, because the property is worth 20 million, it doesn't mean the shares are worth 20 million. If the company has got in it a property worth 20 million and borrowings of 15 million, then ignoring tax, which we're not going to ignore, we're going to come on to, but ignoring tax, obviously you'd only pay 5 million for the shares, because as soon as you've done the acquisition, you're then going to have to pay the bank back 15 million. So that's one sort of war story to watch out for.
Yeah, and now quite appropriately, let's give Dan a break, and we'll move on to the tax implications of these alternatives and drill down a little bit further. So over to you, Sam. Let's just start sort of before we dive in fully. We may need to think, even before we get onto, what are we buying? Is there any pre-sale restructuring that needs to be done? Do you want to buy everything of this business, or is there just, say, one subsidiary or a particular part that you need to carve out? If there is, then we need to think about a pre-sale reorganisation. So, Sam, give us a heads up here, the sort of things we're talking about.
So I think it's worth saying from the outset that this pre-deal reorganisation will need some commercial rationale behind it, and that's from a seller's perspective, and that commercial rationale can't be that they only want to sell part of the business. So what we'll need to do is make sure the sellers will want to, if the deal falls through, have a reason for having those two businesses separate, and whether that's because the two businesses are really two separate businesses that should be run, have different risk profiles, and therefore need to be in two different corporates away from each other, or if the deal does fall through, they want to implement an EMI scheme or another share scheme in the business that would be sold, so they can incentivize management to make it run without the current owners needing so much input. So we'll need that sort of thinking to be done while holding hands with the sellers. It's the sort of advice the sellers would need, and would probably need advice which is being provided separate to the advice that you're given as the purchaser. In terms of what are our options for doing some pre-deal reorganisations, we're kind of stuck in the non-statutory demerger area, and that means you can do a capital reduction demerger or a liquidation demerger. And the reason we're in that camp rather than the statutory camp is because if you have a contemplation of sale, you're prohibited from going down the statutory route. The reality is both end up with the same outcome. It is just a few more steps involved, and generally more legals involved in getting all the paperwork drawn up to effect it all.
Thanks, Sam. And I think we should highlight that we've talked in more detail about demergers. I know we've had a conversation that's on our website on demergers, and Andrew Levine, our property tax expert, has expanded further upon that, where we're looking at demerging property interests. So we're not going to cover in too much detail these demergers, just flag it up. But if you'd like to understand a little bit more, do have a look on our website and you'll get to see Sam, myself and Andrew talking about that. So, okay, but that's the headline, isn't it? We can look at doing a demerger to separate that. Back to you, Sam.
And the other thing that sometimes does get forgotten, or not forgotten, left to the last minute, is the stamp duty on these things. And it's just making sure that we're doing any such demergers with as little stamp duty arising as possible, because the last thing you want to do is leave the potential sellers with a large stamp duty charge, which they might try and haggle on the price to get slightly more out of you as the buyer. So just something to think about, really.
Okay, and you've also mentioned there, if we are doing some sort of pre-sale restructuring, tax clearance may be required. Now that links to the point you said, Sam. We can't just do this purely to mitigate tax. We have to be able to demonstrate to HMRC there is some good commercial reason to it, and there are also timing issues to be considered, but we'll expand upon that a little bit later. But hopefully that's just to flag up the point, even before we talk about selling and getting into the detail. Do we need to restructure, or does the seller need to think about restructuring the business before we come along and can make an offer for the right part of the business? It may not be necessary, but just something to be borne in mind. So Dan flagged up the difference between an asset deal and a share deal. Commercially, very different beasts, and also from a tax perspective, they're very different beasts. Dan, I was just going to say to you, I mean, finger in the air, the deals you do, what percentage tend to be share and what tend to be asset deals?
Oh, probably 90-10 or 95-5 in favour of share deals. The reasons is well, probably obvious from the seller's point of view in terms of their tax exposure, but no doubt you'll speak about that in a second.
Okay. Yeah, we're gonna explore that in a bit more detail. So yeah, I'm interested in 90-10. That's probably a little bit more than I would have thought, but clearly share deals are far more common. And let's just now, Sam, talk us through some of the tax issues we need to consider when we're buying a company.
So it's worth remembering, when you're buying the shares in a company, you're buying the history of the company as well. So anything to do with the previous corporation tax, VAT, PAYE, all of that history is coming along with the company. And we'll get on to looking at that a bit later. We've also got to bear in mind that there may be some share options or other shares in place where you as buyer, they will trigger on the sale. So you've got to have a think about who's going to shoulder that tax liability. Is it going to be split between you as the buyer and the seller, or is you going to try and get most of that onto the sellers? We're going to touch on earnouts a bit later, so I'll leave that point for there.
Just to expand a little bit upon that, Sam, I mean, we flagged up there restricted securities. The principle here is the consideration that's payable to the sellers can, if these shares have certain restrictions attached to them, give rise to income tax liabilities rather than capital gains tax liabilities. Now, I know we said we're focusing on the buyer's perspective here, and we might say that's not our problem, but the concern is we may have to operate PAYE to the extent there are these income tax liabilities. So that can apply if there are restricted securities and there are various protective elections the sellers may have made that we'd look at as part of the due diligence. Share options we've also flagged up there, maybe just to expand a little upon that. Commercially, Dan, you need to be careful. You need to know exactly who's got what interest in the company and what they're selling. From a tax perspective, and certainly from the purchaser's perspective, bear in mind that not only if these are EMI approved share options, and again, there's further guidance on our website on that, Not only is that good news for the employees who have these options, they're a very tax efficient way of getting equity into their hands, but the company is entitled to a corporation tax deduction generally on the exercise of those options. So who gets the benefit of that? What can be a very significant tax saving. We had one deal, I recall, where employees at the onset of the business were granted options at a market value of £5, and those shares were worth, I think, £3 million on exercise. So the company got a £3 million deduction. They effectively got £3 million of shares without any income tax liability. But there was then a conversation about who got the benefit of that £3 million of tax saving. Should that be the sellers, or should it be taken into account for the purchasers? And again, I don't think there's a right or wrong answer to that, Dan, is there? But it's just something to be aware of, and the parties will have to discuss.
Absolutely, there's no right or wrong answer.
Okay, so we digress slightly. Sam, back to a couple of points you flagged up here. Let's talk about tax residency. I know this has cropped up in a few recent examples.
No, absolutely. I think something that we had one deal that went a bit sideways but did get saved in the end, where it turned out the sellers were the two individuals who are the shareholders were not UK tax resident, and they'd held all the board meetings outside of the UK, and therefore the company wasn't UK tax resident, and the tax implications of that meant that there were potential liabilities in the company which would otherwise have gone unknown. So it's something that's probably one of the questions you ask at the very beginning of the process, is finding out where the directors all sit, because it could fundamentally change the tax analysis, especially if the company hasn't necessarily been treating it as a non-UK resident company.
And we'll sort of drill down again when we look at due diligence and the areas we'll focus on shortly. Similarly, you flagged up there losses. Again, what losses are there in the company? Can they be used? There is certain anti-avoidance, again, we're going to touch upon later. What about stamp duty, Sam?
It's quite simple on a share deal. On the acquisition of the shares, the buyer will pay 0.5% of market value.
Well, 0.5% of the consideration. There are, again, there can be complications if there's an earn out, etc., etc. But look, it's a buyer's tax is the point, and generally it's not a deal breaker, the stamp duty. But I think more relevant is the point you flagged up earlier, is if there's any pre-sale restructuring, does that create any additional tax liabilities? And just coming back to one point that links to what I think Dan was talking about earlier, if you do a share deal, as Sam has put on the slide there, you're requiring the tax history of the target, and that includes the tax base cost of the assets. So in Dan's example, where we're buying a company with a property worth 20 million, if we're buying the shares, are we buying any inherent tax liabilities to do with that property? Again, who bears the cost of that? But normally, it would be fair to say a purchaser would discount the price to take into account that inherent tax liability.
Yeah, I mean, if you're talking specifically about property deals, it becomes a bit circular, the argument, or sorry, not circular, iterative, because of course the buyer will say, well, you know, I don't want to be hit with the latent tax charge on the gains already accrued on the value of the property. But then the seller will say to the buyer, oh, but by doing it as a share deal, you're only paying 0.5% stamp duty instead of 5% or whatever it might be. And so it becomes a bit iterative, but inevitably there will be a deduction for the inherent tax liability on the gains accrued in the value of the property in a company. Yes.
Okay, thank you. So let's compare and contrast that to an asset deal. And I think just to cover off that point, Dan, that we've all talked upon there, if we buy the assets, if the property's worth 20 million, we pay 20 million, we've effectively uplifted the base cost compared to a share deal. But more generally, we're not acquiring the tax history, are we, Sam? So we don't have those same worries about any tax liabilities crawling out the woodwork. But what other things do we need to consider?
I think, yeah, there is the key point is it's the tax history. I think making sure that within the SPA, the consideration is apportioned between different assets, so we know exactly what we're paying for what assets, is very helpful. And the reason that's helpful is this Section 198 election, which if some of you have come across it, some of you might not have come across it, but the key point is the buyer and seller are agreeing for tax purposes the value of those assets, which you can get capital allowances on. So it will fix the value that is deducted from the seller's pool, and add or fix the value that is added to the buyer's pool of assets. So you need to make that election, otherwise HMRC won't accept that you will get capital allowances going forward. So it just needs to be one of those things that's thought about. It should be within the legals, but just make sure if you are reviewing some legal documents in relation to an asset purchase that there is such an election in there.
Yeah, and I think we should be clear here. Not only should the SPA reflect the consideration, there should be a standalone election made and submitted to HMRC, because as you said, not only would that potentially preclude the purchaser from capital allowances on the fixtures and fittings in that building, any subsequent purchase of that building is also precluded from getting capital allowances. So it's quite nasty, and the legislation doesn't work both ways. The vendor still has to bring in proceeds even if the purchaser doesn't get anything. So as always, it's all stacked in the revenue's favour there.
Before you carry on, sorry, just to be very pedantic, and I do apologise, if it's an asset deal, of course, there's not going to be an SPA, which is a share purchase agreement. It will probably be an APA, a share purchase agreement.
Thanks, Dan. Yeah, it's a fair point. I mean, just generally as well, I think the point we should make here is it's not for HMRC really to set aside any agreed apportionment between the parties if it is genuinely a third party sale. If these are connected parties, it does get more complicated, but where you are buying assets from a third party, absolutely, as purchaser, you want to think about how best to allocate the consideration to meet your tax profile. That, of course, may not marry with the vendor's profile, but at least know what it is you are buying and how best you can get tax relief as a starting point in the APA. Thank you, Dan. So a couple of other points to add here, Sam.
It's one point is on the losses, and bearing in mind that most are third-party buyers and sellers, and they're not going to be connected, you won't be able to buy the losses as well in an asset deal. So it's just worth considering what trade you're doing, what trade you're buying. The other thing which I think Dan did touch on earlier was the stamp duty land tax on the property, and that's why in property deals we do see people buying the company rather than the property, especially with residential property, because you get hit with massive SDLT charges. And I guess the third point which always gets left is the VAT, and we need to make sure that the bundle of assets you're purchasing do constitute a business, so that we can fall into the transfer of a going concern rules, which in short mean there should be no VAT on the purchase of those assets. But we do just need to make sure that we're falling within those rules, and there's usually provisions within the APA just to make sure that should any risk arise or any VAT arise, the appropriate party is making good on that VAT.
Yeah, we do need to be careful here. We've had a few war stories, haven't we, where what's being sold is clearly a business, but it's being subsumed by the purchaser within their business, and the concern's been raised is that it is a business at the moment, but is it a going concern? That business in itself is not going to continue within the purchaser, and so there is doubt as to whether the TOGC treatment would apply in those circumstances. So there's quite a few little pitfalls there, and that often does get forgotten about. It shouldn't. It can really bite you if you're not careful. So always consider the VAT. You know, at the end of the day, if both businesses are VAT registered, it may only be a cash flow issue, but that's not always necessarily the case. So that certainly shouldn't be forgotten in such transactions, even if it would seem that there shouldn't be an issue.
And the last point, which isn't tax but does need to be thought about, is 2Pay or 2P, depending on where in the country you're from. You just need to be careful. It's quite a complex process, and a lawyer will normally hold the hand through that process, and it's just a formal process does need to be followed, otherwise potential liabilities could arise. So just bear it in mind. We don't want to leave it to the last minute because the process can take a while.
Yeah, I think that's the key point, isn't it? It's the practical point. Yes, it's one for the lawyers, but just bear in mind this is not a overnight job, as it were. There is a formal consultation process with all of the employees, broadly designed to protect their employment rights. And that's what we're driving at here, but it can't really be shortcutted even in an emergency. So quite different, a share and an asset deal. Let's just now come back to how we structure the consideration. Dan, I think lead us off on this one.
Yeah, I mean, the main types of consideration that are paid to acquire something will be, and I actually said cash on completion. I mean, it doesn't have to be cash. It could be some other asset in kind of cash. So it could, it could be the transfer of an asset. But if we're talking about cash, really, there's three types of consideration. There's cash that you pay on day one on completion. There's deferred consideration, so a fixed amount of cash that is paid at a predetermined date in the future, or dates in the future. And the third type is conditional deferred consideration, commonly called an earnout, which will be future consideration that is dependent upon something, typically the future results of the business. It could be a percentage of turnover, it could be a percentage of profits over a certain amount. It could even be, you'll get paid a certain amount if you manage to keep your major customer or something like that. The point is, it's conditional upon some future events post completion.
Okay, Dan, I'll pick up on the tax perhaps on those sections. Second, you just want to cover off the point about the accounts we tend to use for the purposes of, we talk about share deals,
Yeah,
really, aren't we?
We're talking about share deals here. So once the price has been agreed, there's often an adjuster to the agreed consideration, depending on the actual balance sheet, effectively, that's being acquired on the date of completion. It protects the buyer, because if between shaking hands on a deal and actually completing a deal, the vendors have sort of paid a large dividend or somehow asset stripped the company, so by having an adjustment, it protects the buyer. It does also give upside protection to the seller as well. It effectively means they can be rewarded for the post-tax profits they've earned until the date of completion. So deals these days are often said to be done on a cash-free, debt-free basis, subject to normalised working capital. So what that means is you'll pay for the cash, the consideration will then, the debt will be deducted from the consideration, but of course that in itself, cash could be unusually high or low on any particular day, and if it is unusually high or low, it's probably at the expense of working capital, and therefore it's subject to normalised working capital. And this is where there's a lot of arguments can happen, and we've got lots of war stories. But the simple way of normalising working capital would be to take the average over the last 12 months or something like that, typically 12 months, because then you're stripping out seasonality. But even that might not work. We had one recently where there was a very, very large debtor that accrued for 3 months in the year. It was billed in 1 month and it was paid 3 months later, but it was unusually materially large, so we had to adjust the normalised working capital to take account of that unusually large debtor. We had another one recently where the debtors across the whole business were unusually large for a very particular reason. It was tied into litigation. I won't bore you with the details, but what we actually said in that one was that the working capital is unusually large, and so we insisted that's got to be the normalised, but the sellers negotiated in that they would, once the working capital come back down, once all the large debtors that have been building up were paid off, that they could be an adjuster to the working capital. So there's lots of interesting arguments to be had over normalised working capital. The other point on this is, at what date are you doing the adjustment? So typically it was always done on a completion accounts basis. In other words, you draw up a balance sheet on the date of completion, and that would say what the actual cash, debt and working capital on that date was. That gave uncertainty to a buyer. They wouldn't know how much they've got to pay. And if working capital was obviously cash, they're acquiring cash, they get the cash that they need to pay, so it's not a problem. But if working capital is large on completion compared to normal, then they're going to have to find the extra cash to pay for it, and buyers don't like doing that. So what became a bit more fashionable recently is some kind of lockbox mechanism, where effectively it means that economic ownership is being transferred at some date pre-completion, close to completion, typically 1, 2, 3 months earlier, and you agree to lock the box at that date. So you do dummy completion accounts at that date and determine the cash, debt and working capital on that date. the agreements then get a bit complicated because you want to make sure there's no leakage, in other words, no dividends, for example, after the lockbox date, and then it gets more complicated by permitted leakage. That's not for now, but it's a very important thing to think about when you're buying, is are you going to take the risk that you don't know what the completion consideration will be until the completion accounts are determined, or do you want to lock the box?
Okay, thanks, Dan. I'll let Dan look at that one question that's come in. Well, I'll just reflect from a tax perspective. Now, I know we said, as I say, we're focusing on the buyers today, but let's just flag up the tax consequences of cash on completion, deferred consideration and earnouts. Well, of course, the vendor, let's assume they're just a vanilla UK individual, will pay capital gains tax on their proceeds. If it's just deferred consideration payable in X months, X years time, that's all taken into account at the date of exchange. So you will pay tax based on the assumption you get all of that cash and you've received it all on the date of exchange. If for whatever reason that part of it becomes irrecoverable, you can make an adjustment. But the principle is it's a disposal in the current tax year at the date of exchange. You pay the CGT typically at 20% or perhaps 10% on the first million if you qualify for business asset disposal relief, 31 January following the end of the tax year of the sale. Earnouts are a little bit more complicated, and I just want to say a few words on this. So as Dan said, you sell for X million and there's an earnout that's based on future profit. So it's unascertainable at the point of sale. From a tax perspective, what we have to do is look at the expected value of that earnout, and you pay tax on that up front. And effectively, there's adjustments as that earnout crystallises. So you still pay CGT on the full amount. That's the principle, but this is one of these areas we do need to be careful of, because HMRC have said that in certain circumstances they will regard earnout proceeds as potentially being subject to income tax. If, for example, the earnout is dependent on personal performance targets rather than the performance of the business as a whole. So if the individual is required to stay on for longer than might be considered a reasonable handover period, then again, part of that earnout could be considered as subject to income tax. So what we're trying to distinguish between is the earnout being genuine consideration for the value of the business at that point in time, and anything that's disguised remuneration going forward. So if, for example, you stay on but you're on a pittance of a salary going forward, again, that may raise suspicions with HMRC. There is some guidance on this, ERSM 110940. I'll put that in the notes for anyone who wants to have a look of the sort of things the revenue will look at in such circumstances. And earnouts can also create a few problems as far as ascertaining the stamp duty that's payable. There's a so-called contingency principle that says if it's unascertainable, what's the maximum you can get? That will cap the stamp duty. But again, that's something that needs to be looked at. So we'll look at that in a bit more detail. Dan, do you want to just cover off? We've had one question.
Yeah, David, thank you. David asked a question about, can I expand on the definition of debt in cash-free, debt-free? There are always arguments over that. I mean, debt on the simple level is any form of borrowing. So it would obviously include loans, overdrafts, finance amounts due on finance leases, and such like. It would include any amounts due to the sellers. Then it typically includes corporation tax, but typically other forms of tax, in particular VAT, but also PAY and NIC, are typically not included within debt. Deferred tax is usually excluded from cash debt and working capital in its entirety. There's always a few arguments over other things, like if a lot of cash is tied up as deferred revenue, then the deferred revenue could be some form of debt or negative cash or whatever. There's no hard and fast rule, but certainly any forms of borrowing and corporation tax are inevitably debt.
All right, thanks, David, for that. Just following up from what we're talking about, again, as I say, I know we're looking at this from the buyer's perspective, but I said previously deferred consideration is taxed up front. Well, there are ways to defer that. If instead of taking just an entitlement to cash in the future, you take securities. Typically, these are in the form of so-called non-qualifying corporate bonds. And the idea there is if we can get clearance from HMRC that this is all being done for bona fide commercial reasons, then you only pay tax when those securities crystallise, so when you encash them. So you get a deferment. Obviously, you might take the view with CGT rates going up, is that a wise thing to do, or should you pay the tax now and bank the what potentially are lower rates of tax? That's one, I think, for another day, as it were, but just be aware as a purchaser, the vendor is going to want to get, if they're properly advised, tax clearance for such treatment, that they get this rollover treatment. HMRC have 30 days to respond. If they ask questions, that can push it back further. So all of this should be built into the timeline. If you are receiving debt or entitlement in the future, the SPA may build in interest on that debt. And then we need to think about withholding taxes, particularly if the vendor is resident overseas. We might think about reducing those withholding taxes under the relevant double tax treaty. Or there are more complex ways of mitigating the double tax, be it so-called qualifying private placements, be it issuing euro bonds or listed securities. That tends to be for larger, more complex transactions. But again, just to flag that up, there are alternatives if withholding taxes are potentially an issue there. So time marches on. Dan, just give us an overview of the sort of process, timings, the orderings, etc., once we've got a potential deal on the table.
Yeah, so we've after you've made your approaches and negotiated with the buyer, you get to the stage where, with the seller, you get to the stage where you're going to shake hands with them, as it were, and typically heads of terms are entered into at that point. They're normally non-legally binding, sort of letter of intent type thing that sets out the main headlines of the proposed transaction. At that point, obviously, as a buyer, you're going to take tax advice, and Sam and Nancy are going to talk about that in a minute, or have been indeed for the last half an hour. If the buyer needs to raise finance, then obviously they've got to sort out their financing at this point. It could be debt finance, it could be equity finance. There's obviously a big difference. I was talking before about cash buyers, so if they've got the finance within the group, or they've got to go and raise external funds, will delay matters significantly. Do you want to pick up on the tax issues of finance? Or
yeah, there's just one important point here, but it is very important. Sometimes what you might do is try and use the cash that's in the company you're acquiring. If it's got significant cash, you might think, well, okay, we'll lend that cash up to the company that's doing the actual acquisition, and those funds will then be available to pay the vendors. That can create so-called Section 459 tax issues. Now, I'm sure most of us are aware that if a shareholder takes a loan out of a company, if that loan isn't repaid within 9 months, then the company has to account for tax at 33.75% of that balance, which is ultimately recoverable once the loan is either repaid or waived. Now, where we've got a loan from one company to another, most people would assume we're not caught. There's no individual shareholder taking the cash out. But this is anti-avoidance that says broadly, if that cash in the subsidiary that's being acquired ends up in the hands of a shareholder, Section 455 applies via Section 459. And it's something that HMRC are becoming increasingly conscious of. It's not always, the point hasn't always been taken in the past, but absolutely it applies in those circumstances. It is only cash flow, but it's a very significant piece of cash flow at 33.75%. So something to be aware of and to plan around. There are ways to mitigate that, particularly if the target company being acquired has reserves, but just be aware that is an issue.
Thank you. And then you've really got two processes which will happen at the same time. So one is the lawyers will get on with preparing the legal documentation. I say the lawyers would obviously have a lot of input as well into all the financial, accounting, tax implications therein. And the other is due diligence. If it's a share sale, there's inevitably going to be due diligence. We mentioned before the difference of acquiring the tax history and the tax liabilities of a company where it's a share sale. It's not just the tax. If there are any off-balance sheet liabilities, any past liabilities that might not crystallise yet, contingent liabilities and so on, they obviously belong to the company. And caveat emptor says that the buyer will inherit them. They belong to the company, and therefore the buyer can't just go to the seller afterwards and say, this happened and do your watch pay up? It's the company's liability, and therefore the buyers inherited them. So the buyer's going to want to do a lot of due diligence to satisfy themselves that there aren't any unknown liabilities, whether they're tax or non-tax, hiding in the business. And we'll talk about types of due diligence in a minute. Once the funds have been raised, once the legal documentation has been agreed, once the due diligence has all been signed off, then the parties can go and complete and enjoy the typical celebratory glass of champagne afterwards.
Okay, so let's now move on to the due diligence, which has two aspects really to it, Dan. Well, various aspects. Do you want to give us a heads up of the various aspects before we drill down into the tax?
Yes, I mean, I've listed here some of the main types of due diligence. A bit of a shameless plug in terms of the main bullet points as due diligence is that we're very happy to do at BKL. So financial due diligence, tax. Almost any deal will always have financial due diligence, tax due diligence, and legal due diligence, which obviously the lawyers will do. We're doing a lot more commercial due diligence. We're doing a lot of HR due diligence, and then there'll be all kinds of other types of due diligence that you might have in particularly larger deals, which could include environmental, pensions, employee, and so on and so on. But as we said before, it's all really about knowing everything there is to know about the target business to help you integrate it post completion, and also to ensure that there's no skeletons hiding in the cupboard, as it were.
Yeah, this is the proverbial kicking the tires, really, isn't it?
Yes.
And one other important area I think that's becoming more and more relevant is IT due diligence, isn't
Yes.
it? Making sure systems are robust, etc., etc. All right, thanks, Dan. We're now going to focus on the tax due diligence, and this is one for you, Sam. So take it away.
So we're gonna canter through this. I've included on the slide the different areas we generally tend to look at. It's worth kind of as a starting point. The period under review, depending on what the client wants you to look at, is different in different deals. We'd usually suggest a 6-year period, but we can and we do often see people, as a way to reduce costs, doing it for just the open periods which are currently open to HMRC inquiry, and that's for corporation tax. So if you can think of any areas that there may be a problem, we generally go and have a look at it, just so that you as buyer can get happy that nothing will come out of the woodwork post transaction. Yeah, I think one of the key things just to pick out on this slide, if I'm just going to pick one out, would be the losses and their future utilisation. If you're buying a company with losses in them, there are lots of anti-avoidance rules around when and how those losses can be used going forwards. You generally need to be quite careful for a period of 5 years after acquisition. So just something to bear in mind if you're buying a company with losses and wanting to use them. You might want to have a think about, can I actually access those losses in the time period that I want to be holding the shares in this company?
Yeah, and just expand upon that a little. You're too young, Sam, but Dan may remember, and I certainly remember, there used to be a market in selling companies purely with their tax attributes, particularly if they had capital losses. None of that works anymore, but with trading losses, broadly, as long as there's not, as the legislation talks about, a major change in the nature or conduct of the trade, so you keep doing what the company's always been doing, potentially those losses should be available. But this looks also back as well as forward, doesn't it? So as part of the due diligence, we need to establish whether there's already been that major change in the nature or conduct of the trade. So yeah, that's certainly one very relevant point to bear in mind. Should we just quickly mention degrouping charge as well? Less relevant because of certain technical changes, but again, it's all about understanding the business, isn't it? Have there been assets moved within the group? In which case we do need to consider whether those exit charges, be it from a capital gains tax perspective, under the intangible assets regime, or in particular the really nasty ones can be on the SDLT side, whether they can bite. But the key is really to understand the business and what it's done. If we understand that, then we can analyse the tax. So okay, let's plough on, as it were, on a few other related tax areas, Sam.
So PAYE and VAT are two other big areas of tax. Something we're seeing quite a lot of at the minute is contractor arrangements. They were going out of vogue because of the reforms to IR35, and are now starting to come back into vogue given the new changes and updates and everything. So it's one of those things where you need to be mindful of, and just reviewing agreements. It's sometimes not only us as tax advisors need to have a look, but it's also getting a legal view sometimes on whether or not they think the IR35 rules are contradicted. In terms of VAT, we need to be making sure that the company is fully VAT registered and all its suppliers are fully VATable if they're reclaiming 100% of the VAT. We do sometimes see where the company might have insurance premiums coming in which are exempt for VAT purposes, and that would then partially exempt the company potentially. So it's just making sure that you really give a good look over and understand what the revenue streams are when thinking about the VAT position. The capital goods scheme is something that also needs just thinking about. And then finally, I think the option to tax on properties, just making sure that they are option to tax if applicable, and making sure that the paperwork is received. I mean, I've come across a couple of times where they said the property has had an option to tax, and it turns out it isn't, and they can't find the paperwork, and HMRC have no record of it. So it's just something to bear in mind when carrying out the review.
Yeah, and when we're talking about option to tax, we're talking about property, we're talking inevitably about very substantial numbers. Similarly with the capital goods scheme, this is, we're talking about, I think it's more than £250,000 of capex, isn't it?
Yeah.
Where again, there can be a VAT clawback if we're not careful. So something we should very much consider, along with
the last two bits, the stamp taxes, which you've touched upon very slightly already, which is the SDLT and possible degrouping charges. Stamp duty on the share acquisition, we need to be mindful of also on any past deals. So it's looking at what has the company purchased, has the right amount of stamp taxes been paid, and it might be that if a property is purchased and a specialist stamp duty advisor gave advice on it, does that scheme work? There are lots of SDLT schemes out there which may or may not work. There's a lot of literature and court rulings on this, so just something to bear in mind. And the other two biggies are the construction industry scheme. If I remember rightly, it's £1 million is your threshold in being able to lay out in construction sort of expenditure on subcontractors without needing to register, and also any tax avoidance schemes the company might have entered into, and whether or not are there any cases going through the courts at the minute which could potentially lead to the tax avoidance scheme not working. So it's just really, as Anthony said earlier, a proper health check on what has the company done in the past 24 months as a minimum and up to 6 years in terms of their tax filings.
I think commercially, Dan, if you are thinking of selling your business, not only do you want your tax affairs to be clean, you also want to be able to prove that your tax affairs are clean. So you want your books and records to be up to date, to be consistent, to reconcile. We've had cases where people have changed accounting systems, and it makes it very difficult for someone coming into due diligence to extract that prior information. So, do think about it if a sale is potentially on the table, that you can provide all this information on a timely basis. If it's inconsistent, if it's not all there, you're just going to frighten off a buyer, aren't you?
Yeah, that's absolutely correct. What's become more common recently is vendor due diligence. In other words, the vendors would actually instruct their own due diligence, either sometimes even before putting the business up for sale, so that they can identify what the issues will be and address them before they even sell the company. And of course, the other thing worth mentioning is that if they're, if the vendors want to be able to sort of go and sit on the beach and not worry about any warranty claims, that they can always take out warranty and indemnity insurance on completion, so that they can not worry about any future claims.
Okay, which leads us on to the next area we just wanted to cover off. So we've done the due diligence now. Where does that take us to? Well, inevitably, it may identify some tax exposures, etc., etc. Very rarely do we find things when we're doing the work, I think, that would lead us to completely walk away from a transaction. Albeit, as Sam said, we did have issues over the residency of a company that was fundamental. But typically, these are relatively small exposures, which, if you're on the other side, you know, it gives the vendor the chance to regularise the position. As a purchaser, you would want to make sure, first of all, that any such specific indemnities are included in the SPA to cover off those tax risks. You might insist on a holdback if the issue is subjective and it's not clear whether HMRC would take the point. You might adjust the consideration full stop to take into account those risks. So you'd certainly want to make sure that the SPA covers off those tax risks, in particular the tax deed covers off those. We'd also need to consider the warranties. Do the warranties, these are really just designed as an information gathering exercise. So we warrant the company's tax affairs are up to date, it's paid its tax on time, it's been a good boy generally is what we're trying to say. Again, depending on which side of the fence you're on as a purchaser, we're focusing on what disclosures has the vendor given you? Is that consistent with the due diligence? If it's completely out, that may call into question, you know, is this the sort of people you want to do business with and get into bed to? But hopefully there should be, you know, if they come and just hold their hands up on a couple of small points and that ties into what's been picked on due diligence, all good, not a problem. But the last point there can be important. Has there been anything identified that could lead to the consideration being subject to income tax? Because it's probably going to be due under PAYE. So where there are earnouts, etc., you do need to be careful. We had one case recently where there was an earnout, but the difficulty was if one of the selling shareholders left employment, their pot or their entitlement to the earnout went back into the general pot and it was a last man standing. So all of a sudden, it could be construed that if you're one of those vendors who is retained in the business, you are now getting a much larger sum than is probably fair or entitlement in respect of your shareholding. That potentially can be subject to PAYE and can create difficulties, but probably enough. Dan, did you want to add anything on that?
Just, I mean, we're never going to use due diligence as an excuse to reduce consideration, but obviously if there is a valid concern from the buyer, then they've got to do that. I honestly think some of the best advice I've ever given. I remember one deal a long time ago where my client was desperate to buy this particular business, and we identified so many concerns that we said to him, "You've got to walk away from it." He didn't want to, but he did, and it was perfect advice. The business went spectacularly bust 6 months later. So due diligence isn't an excuse to reduce consideration, but if there are valid concerns, the buyer's got to act upon them.
Okay, thank you. So hopefully we've done the due diligence. We sign. I mean, the other point. Sorry, I'm just going to add one more point there. I think where we need to be careful is there is a certain overlap between the lawyers and the accountants and all of this. And I think, of course, we're happy to do everything as far as tax deeds, etc. Well, that's not strictly true. We will have our input, but it's important that there are clear responsibilities and everyone knows who's doing what, because where things tend to go wrong is just on the practical point. So yes, we will always review the tax warranties, the tax deed, we will make amendments, but it's for the lawyers to deal with any substantive redrafting or drafting to add in any additional indemnities that we feel are appropriate. But it's just making sure those communication lines are kept open and nothing is missed was the point I was going to add. But hopefully we then get this deal over the line. And just to finish with, again, just a little war story. We've been involved in transactions where it goes down to the last minute inevitably. There's manuscript adjustments. You need to make sure you get the final bundle of documents. I know we had one significant transaction. We asked and we didn't get it. And 2 years later, it can be sometimes we're preparing a tax return for the vendors and we don't even have a final copy of the SPA on which to base those tax returns. So it sounds silly, but just be aware, make sure you do get that. And often, it's worth documenting at that point in time the tax consequences for all the vendors so it doesn't get lost. Even, it can be years before HMRC asks questions. So we shouldn't forget that. And the other point was about post-completion integration, Dan, isn't it?
Yes, I mean, it comes back to the point I made earlier about many acquisitions failing to add shareholder value. Yeah. I think a lot of people focus so much on completion and then have a big sigh of relief once the deal has completed. That actually that's the easy bit. The difficult bit is day one and day two and day 100 and so on, and is properly integrating the business, tax affairs, non-tax affairs, everything, making sure that there's cultural fits, and really maximising the value of the asset that you've acquired.
Yeah, and similarly, often when you buy a business or a company, if we're talking about a share deal here, you want to put the two businesses together. You don't want to be running parent and target as separate businesses. you might think about merging. Now, this is one for another day, but typically, Sam, we talk about hive ups, and we need to think about the tax consequences of that. Generally, it can all be done tax-free, but as always, there are pitfalls. And finally, you might want to think about liquidating the purchase company as and when you've merged its business into the business of the acquirer as a whole. But that's one for another day. And that, friends, is pretty much it. Thank you, Dan.
Thank you.
Thank you, Sam. There are lovely photos. Sam's the one with far too much hair, if I may say so. But thank you all for listening. As I say, we will circulate the slides and a copy of this webinar. If you've any more questions, do feel free to let us know. But thank you to my colleagues. Thank you, I'm going to say to David Goldstein, who's the hero behind the power here, who does all the hard work. Thank you, David, for assisting. I'm off to look lovely at the league table, but hopefully we'll see you all soon. And thank you for joining us. Bye now.